Welcome back, everyone. Today, we're delving into a hot topic that has been making headlines: the unprecedented money printing by the U.S. Federal Reserve. In the wake of the COVID-19 crisis, the Federal Reserve has been using its unique powers to inject trillions of dollars into the economy. But how does this money printing work, and what are its implications? Let's break it down. So, what's this superpower that the Federal Reserve seems to possess? It's the ability to create dollars literally out of thin air. With just a few strokes on a computer, the Fed can print money electronically, injecting it into the commercial banking system. It's like magic, but with economic consequences. Now, why is the Federal Reserve resorting to such measures? Well, it's part of a larger strategy to rescue the U.S. economy from the impacts of the COVID-19 pandemic. The Fed is projected to have purchased a staggering $3.5 trillion in government securities by the end of the year, using these newly created dollars. But how does this process actually unfold? Let's demystify the process. The Federal Reserve essentially creates money by purchasing government securities, such as bonds. This infusion of money into the economy aims to stimulate spending, investment, and overall economic activity. It's a tool the Fed uses to combat the economic downturn caused by the pandemic. Now, you might be wondering, where does this money come from in the first place? It's crucial to understand that the Federal Reserve isn't physically printing bills, it's creating electronic reserves. This process doesn't directly lead to inflation, as the new money is injected strategically to address specific economic challenges. However, not everyone is on board with this approach. Critics raise concerns about the potential long-term consequences, including inflation and a devaluation of the currency. The debate around how far the Federal Reserve can go with its money creation is a hot topic among economists and policymakers. As Tchernova explains, the Federal Reserve, instead of printing physical money, engages in a rather straightforward process. They have the power to credit banks electronically. It's as simple as typing in the necessary digits. This method allows the Fed to inject funds into the financial system swiftly. But why does the Fed employ this money typing strategy? Well, during times of crisis, like the onset of the COVID-19 pandemic, markets can seize up in fear. The Fed's goal is to keep these markets functioning smoothly. By crediting banks, they ensure a steady money supply and lower interest rates, making credit more accessible. Experts agree that without the Federal Reserve's emergency measures, the economy would have faced a severe crash. The purchases of government securities and the money typing strategy have played a crucial role in stabilizing the economic ship. Fed Chair Jerome Powell himself stated that these actions have substantially improved market conditions in recent weeks. Let's take a closer look at the impact. The strategy not only keeps markets afloat but also makes credit more accessible. This, in turn, facilitates spending, investment, and overall economic activity. It's a multifaceted approach aimed at preventing a domino effect of economic downturn. Have you ever wondered how the Federal Reserve's bond purchases affect the economy? Well, it turns out, one practical result is the creation of money to finance the colossal debt run up by Congress. But how does this process work, and what are the implications? For critics like former Republican presidential candidate Ron Paul, the idea of creating money to finance debt seems mind-boggling. In an era of almost $25 trillion national debt, the traditional notion of sound money based on work, savings, and investment appears outdated and, according to some, a relic of the past. In a seemingly financial fantasy, the federal government is not just creating dollars but using them to pay down its own debt. The question arises, can we really pay our credit card bills by simply pressing a button? Well, the government can, and it's more complex than it sounds. The bigger question is whether it's sound and sustainable. Let's demystify the process. The Fed, unlike the U.S. Treasury, doesn't physically print paper dollars. Instead, it engages in large asset purchases, creating electronic dollars and adding them to banks' reserves. It's a strategic move during times of crisis, such as the massive shutdown triggered by the pandemic. So, is this financial strategy sound and sustainable? The answer is subjective and depends on who you ask. As the government continues to create fake money to navigate these economic challenges, the debate around its long-term consequences intensifies. Contrary to popular belief, the Federal Reserve doesn't physically print paper dollars. Instead, it engages in a complex process to inject money into the economy. Let's break down this financial ballet step by step. In times of crisis, such as the current pandemic, the Fed doesn't print physical dollars. Instead, it makes large asset purchases on the open market. Newly created electronic dollars are added to the reserves of banks like Wells Fargo, Goldman Sachs, and Morgan Stanley. In return, the Fed receives substantial amounts of bonds, including U.S. Treasury securities and agency securities backed by home mortgages. These asset purchases serve a dual purpose. First, they unfreeze markets that had seized up in fear, allowing banks to have more dollars in reserve. This makes them more willing to lend money without fear of a run on the bank. Secondly, such large-scale securities purchases effectively increase the money supply and drive down interest rates, keeping borrowing costs affordable for those in need. Meanwhile, Congress has been passing massive spending bills, significantly increasing the national debt to support businesses and taxpayers. This money often comes from issuing U.S. Treasury securities, with foreign and domestic investors being the primary holders. However, the Fed has joined the circle, purchasing a significant portion of these securities since mid-March. In a fascinating financial circle, the Fed, one arm of the government, creates dollars to buy government debt in the form of securities issued by another arm, the U.S. Treasury. The interest paid by the Treasury is returned to the Fed, creating a unique financial loop. Looking ahead, the Fed's unprecedented crisis plan involves lending over $2 trillion to businesses, states, and local governments. While Fed Chair Powell expects repayment, former Vice Chairman Alan Blinder notes the importance of the Fed remitting profits to the Treasury. This financial safeguard becomes crucial if some loans fail, impacting the budget deficit. Renowned economist and former Texas Congressman Ron Paul, in his book End the Fed, predicts disaster as a consequence of the Federal Reserve's creation of money. He argues that this influx of easy money could lead to overheated financial bubbles, ultimately bursting and causing painful fallout. But does history support this claim? One of the key concerns raised by critics is the risk of inflation. Paul contends that creating too much money, especially when there are too few goods in the system, could lead to price inflation, eroding the purchasing power of the dollar. It's a valid concern, but is it the only side of the coin? Interestingly, the last time the Fed created money on a similar scale during and after the Great Recession, high inflation didn't materialize. Instead, a more pressing concern then, as well as now, has been persistently low inflation. This raises questions about whether the risk lies more in the direction of deflation, falling prices that can prompt consumers to delay spending, thereby hurting the economy. Understanding the factors influencing inflation is crucial. It's not just about the sheer quantity of money in circulation, but also about how fast it moves and the overall health of the economy. The relationship between money creation and inflation is complex, and various economic indicators come into play. The debate around the Fed's monetary policy is ongoing. While critics like Ron Paul warn of disaster, proponents argue that the current economic landscape, with persistent low inflation, demands bold measures to stimulate growth. The question remains, will the Fed's moves lead us to economic disaster, or are they necessary steps in navigating these challenging times? With the economy struggling and inflation at historical lows, fears of high inflation seem, according to some, far-fetched. Noted economist Alan Blinder dismisses concerns, emphasizing that the current crisis, induced by a pandemic, has forced both the Fed and Congress into extraordinary measures. So, are we in uncharted economic waters, or is this business as usual? Cherneva, a proponent of modern monetary theory, asserts that the government can always pay its bills by creating more money. This theory minimizes the importance of deficits and debt, challenging conventional economic wisdom. According to her, the current situation highlights the government's ability to self-finance, especially when facing urgent budget requirements. As we explore the realms of modern monetary theory, it becomes clear that not everyone is on the same page. While Cherneva sees the government's self-financing as a viable strategy, critics argue that there are economic and global limits to such practices. The debate continues, shaping the economic narrative for years to come. Former Federal Reserve Vice Chairman Alan Blinder sheds light on the Fed's unprecedented crisis plan, lending over $2 trillion to businesses and governments. But what happens if some loans aren't repaid? This time, the Fed's magic lies in its ability to create money at the push of a button. Congress, through the CARES Act, allocates $454 billion for Fed programs, anticipating potential losses. But as spending triples, concerns about the budget deficit linger. How much debt is too much? The Congressional Budget Office projects a $3.7 trillion deficit, raising questions about sustainability. Debunking inflation fears, former Congressman Ron Paul predicts disaster with money creation, while economist Pavlina Cherneva advocates for modern monetary theory. The clash of economic ideologies intensifies as the debate unfolds. The Fed's mandate is clear: maximize employment and stabilize prices. As the economic gas pedal unbrake, it can increase the money supply or reduce it by adjusting interest rates. Striking the right balance is crucial, especially in times of economic emergency. Congress's spending creates debt, prompting concerns about sustainability. Federal Reserve Chairman Powell acknowledges the unsustainable fiscal path, noting the growing debt relative to the economy. Cherneva downplays long-term debt concerns, drawing comparisons with Japan's ability to service debt. As the discussion unfolds, the Fed's magic printing machine takes center stage. Former Fed Chairman Alan Greenspan once stated that the U.S. can pay any debt by printing money. Explore the tools at the Fed's disposal and the potential ramifications of this magical ability. In conclusion, the economic landscape is a tapestry woven with complexities, from debt dilemmas to the magic of money creation. As we navigate these uncharted waters, understanding the dynamics is key. If you found this exploration enlightening, don't forget to like, subscribe, and hit that notification bell for more economic insights. Stay economically informed.